You have $100,000. Congratulations! You worked hard, you saved, you probably skipped some stuff you wanted. But here is what nobody tells you. Having $100,000 does not mean you are suddenly financially intelligent. It means you have crossed a threshold where your next decisions matter exponentially more than your last ones. Most people treat this milestone like a victory lap. They relax, they splurge, they make the same decisions that got them here, thinking momentum will carry them forward. It will not. The first $100,000 takes about 7 to 8 years to save if you are putting away $10,000 annually. But getting to $200,000, that takes only about 5 years at the same savings rate. Why? Your money starts doing the heavy lifting, but only if you let it work. So let's talk about 10 decisions that separate people who plateau at $100,000 from people who build real wealth. And I am not going to sugarcoat this. Some of these decisions will feel wrong. Some will contradict what your parents told you. Some will make you uncomfortable. Good. Your instinct right now is to protect what you have. Makes sense. You worked hard for this. So you think, I will just keep it somewhere safe. A savings account, a checking account, maybe a certificate of deposit. Wrong move. High-yield savings accounts are currently offering around 4.2% annual percentage yield. That sounds decent until you realize inflation has been running around 3% recently. Your real return? About 1.2%. The S&P 500 has historically returned about 10% annually over the past 97 years. After inflation, that's closer to 7% real growth. Let me translate that. $100,000 sitting in a savings account for 30 years at 4% becomes about $324,000. That same $100,000 invested in a broad market index fund at 10% becomes $1.7 million. The difference is $1.4 million. That's the cost of feeling safe. Now, does this mean you should throw everything into the stock market tomorrow? No. You need an emergency fund, 3 to 6 months of expenses in cash. If that's $20,000, fine, keep $20,000 liquid. But the other $80,000, it needs to work. Here's the counter argument. What if the market crashes right after you invest? Valid concern. In about 1/3 of all years, the S&P 500 produces negative returns. But here's the key. Over any 18-year period in the index's history, you have never lost money in real terms. 18 years sounds like forever when you're young. It's not. It's the difference between being 30 and 48, between 40 and 58. How do you validate this decision for yourself? Run your own numbers. Use a compound interest calculator. Plug in your actual savings rate and timeline. See what the math tells you. Then ask yourself, can I afford not to take this seriously? If you have credit card debt, you need to hear this clearly. Pay it off today, right now. Credit card companies are charging you between 15 and 25% interest. Some are higher. You cannot outrun that. No investment you make will reliably beat those rates. Let me give you the math that should terrify you. If you owe $20,000 at 20% interest and you're making minimum payments, you'll spend about $48,000 over 18 years to pay it off. That's $28,000 in pure interest, money you worked for going to a bank, buying nothing. Now here's the other side. Some people will tell you, but I can deduct mortgage interest on my taxes, or my car loan is only 3%. Those are different. If your debt is below 5% interest, you might keep it and invest instead. But anything above that, especially anything above 8%, that's an emergency. Treat it like one. I know what some of you are thinking, but if I pay off all my debt, I won't have any money left to invest. Correct, and that's fine. Because once that debt is gone, your monthly cash flow explodes. Every dollar that was going to interest payments is now going to your future. How to validate this? Calculate your actual interest payments over the next 5 years. if you do nothing. Then imagine that money in your investment account instead. Which future do you want? You have $100,000. You know what that means? Leverage. Most people with 6 figures saved are still paying full price for things they should be negotiating. Your insurance premiums, your phone plan, your internet bill, your credit card fees. Here's a script that works. I've been a customer for X years. I'm comparing providers and I'm seeing better rates elsewhere. What can you do to keep my business? 70% of the time, they'll cut your bill, sometimes by 10%, sometimes by 40%. Let's say you negotiate your car insurance down by $300 a year, your phone bill down by $20 a month, and your internet down by $30 a month. That's $900 annually. Invested at 10% for 20 years, that's $56,000. Most people won't do this because it feels cheap. It feels beneath them. Get over it. Rich people negotiate. Poor people accept the first price. You want to know the difference between the two? The rich people realize their time is worth money and their money is worth protecting. But here's when this doesn't work. If you have bad credit or a history of late payments, you have less negotiating power. Fix those issues first, then negotiate. How to validate this? Track every recurring expense for 1 month. Circle anything over $30 monthly. Call each one and negotiate. Calculate what you save over a decade. This one is uncomfortable, but it's real. When you hit $100,000 in savings, something changes in your social dynamics. Friends who aren't there yet start treating your decisions differently. Why are you driving that old car if you have money? Come on, just put it on a card, you can afford it. No, you are being intentional. There's a difference. Having $100,000 saved allows you to make career decisions from a place of empowerment rather than fear, but only if you keep it. Your friends aren't trying to hurt you, they're just playing a different game. They're optimizing for today, you're optimizing for 10 years from now. And here's the brutal truth. If you keep spending like someone without $100,000 saved, you will become someone without $100,000 saved. Does this mean you cut off everyone who makes less money than you? No, that would make you insufferable. It means you stop taking financial advice from people who aren't where you want to be financially. You stop justifying purchases because everyone else is doing it. How to validate this? Look at the 5 people you spend the most time with. Are they building wealth or spending everything they make? Your financial future will look like the average of theirs. Let me save you from yourself. You have $100,000 and you're thinking, I can pick winning stocks. I'll beat the market. No, you will not. Professional fund managers with teams of analysts and billions of dollars under management can't beat the market consistently. About 85% of actively managed funds underperform the S&P 500 over 15 years. What makes you think you'll do better?
The S&P 500 index has delivered an average annual return of about 10.33% since 1957. You know how hard it is to beat that? Nearly impossible. Here's what happens when amateurs pick stocks. They buy high because everyone is excited about a company. They panic and sell low when things drop. They hold losers too long, hoping to break even. They sell winners too early to lock in gains. All of these behaviors destroy returns. Index fund investing is boring. That is the point. You buy a fund that owns everything, you hold it forever, you add money regularly, and you let compounding do its thing. Buy something like VOO, which tracks the S&P 500, or VTI, which tracks the entire US stock market. Add some international exposure with VXUS if you want diversification. Then, do nothing. For decades. The hardest part about index investing is not the strategy. It is resisting the urge to be clever. Warren Buffett, one of the greatest investors alive, has said repeatedly that most people should just buy an S&P 500 index fund and never sell it. If he says it, you should probably listen. When does this not apply? If you work in an industry where you have genuine inside knowledge and expertise, and you are willing to do real research on individual companies, fine. But be honest with yourself. Do you actually have an edge, or do you just think you do because you read some headlines? How to validate this? Track any stock picks you would have made over the past year. Compare them to an S&P 500 index fund. Be honest about whether you beat it. Here's a hard truth about wealth building. Saving $100,000 is impressive, but it is still limited by your income. If you make $50,000 a year and save 20%, you're adding $10,000 annually. Even with compound growth, you're playing the long game. But if you double your income to $100,000 and maintain that same savings rate, you are now adding $20,000 annually. Your trajectory just doubled. The wealthiest people I know did not save their way to millions. They earned their way there, then saved and invested aggressively. So, what does this mean practically? Get a certification that increases your value in your industry. Learn a skill that is in high demand. Ask for a raise with specific evidence of your value. Switch jobs every 2 to 3 years in your early career, because that's where the biggest salary jumps happen. Start a side business. Living below your means requires discipline, conscious decisions, and a steadfast commitment to long-term goals. But living below your means while increasing those means, that's the unlock. Here's the trap to avoid: lifestyle inflation. You get a raise and immediately upgrade your car, your apartment, your vacation budget. Now you're making more, but saving the same percentage. You're running faster on the same treadmill. Instead, treat raises like they don't exist for 6 months. Pretend you're still making your old salary. Invest the difference. Then after 6 months, if you want to upgrade one thing, fine, but not everything. How to validate this? Calculate what a 20% raise would do to your savings rate if you kept your expenses flat. Then figure out the fastest path to earning that raise. Taxes are the single largest expense most people will pay in their lifetime, and most people don't even think about them until April. If you have $100,000 and you're not using tax-advantaged accounts, you're leaving tens of thousands of dollars on the table over your career. The traditional 401k allows you to invest pre-tax dollars with the advantage of paying your retirement tax rate rather than your current one on withdrawals. Translation: if you're in the 22% tax bracket now and you expect to be in the 12% bracket in retirement, that's a 10% discount on every dollar you invest. A Roth IRA works differently. You pay taxes now, but never pay taxes on growth or withdrawals in retirement. If you're young and in a low tax bracket, this is usually the better move. Health savings accounts are triple tax advantaged. Money goes in pre-tax, grows tax-free, comes out tax-free for medical expenses. After 65, you can withdraw for anything and just pay income tax like a traditional IRA. It's the best retirement account nobody talks about. Let's use real numbers. $100,000 in a taxable brokerage account growing at 10% for 30 years becomes $1.7 million. But you'll owe capital gains taxes on the $1.6 million in growth. At 20% capital gains rate, you pay $320,000 in taxes. You keep $1.38 million. That same money in a Roth IRA, you keep all $1.7 million. That's $320,000 just from choosing the right account type. When does this not matter? If you need access to your money before retirement age, tax-advantaged accounts have restrictions and penalties. You need to balance long-term growth with short-term flexibility. How to validate this? Talk to a CPA or use tax software to model your specific situation. Find out which accounts save you the most based on your income, timeline, and goals. Everyone says you should buy a house. Your parents say it, your friends say it, society says it. And sometimes they're right, but often they're not. Buying a house is not inherently a good financial decision. It depends entirely on the numbers in your specific situation. Here's what most people get wrong. They compare their monthly rent to a mortgage payment and think, the mortgage is cheaper, so I should buy. But that's not the full picture. When you rent, your monthly payment is your entire cost. When you own, your monthly payment is just the start. Add property taxes, homeowner's insurance, maintenance, HOA fees, the occasional new roof for HVAC system. A common rule of thumb: expect to spend 1 to 2% of your home's value annually on maintenance and repairs. For a $300,000 house, That's $3,000 to $6,000 per year. Then there's opportunity cost. If you take $50,000 for a down payment and closing cost, you're not investing that money. At 10% annual returns, that $50,000 becomes $336,000 in 20 years. Conversely, if you buy smart in an appreciating market with a low interest rate, your home value can grow while you pay down your mortgage with pre-inflation dollars. You build equity. You lock in housing costs while rent increases around you. So, which is it? Depends on your market, your timeline, and your interest rate. Here's the rule. If you're planning to stay in one place for at least 5 years, buying usually makes sense. If you're moving in 2 years, renting is almost always better. How to validate this? Use a rent versus buy calculator with your real numbers. Include all costs. Be honest about how long you'll stay. Let the math decide. You have $100,000. That's not the finish line. It's not even the starting line. It's the moment when compound interest shifts from working against you to working for you. It's when your money starts making money. When the gap between you and people who never saved starts widening fast. But only if you make the next decisions correctly. Most people who hit 6 figures plateau. They get comfortable. They stop being aggressive with their money. They let lifestyle inflation creep in. They think they've made it. And 10 years later, they still have $100,000. Maybe $150,000 if they're lucky. They didn't lose, but they didn't win either. The people who treat $100,000 as the beginning, not the end, they're at $1 million 10 years later. At $3 million after 20 years. Same starting point, different decisions. So here's what you do. Keep most of your money invested in boring index funds. Kill any debt over 5% interest immediately. Negotiate your recurring bills. Surround yourself with people who think about money the way you do. Max out tax-advantaged accounts. Decide on housing based on math, not emotion. Protect what you've built with insurance. And automate everything so you can't sabotage yourself. Do those things and $100,000 becomes $500,000, becomes $1 million, becomes financial independence. Ignore them and $100,000 becomes a nice cushion that slowly erodes while you wonder why you're not getting ahead. The math doesn't care about your intentions. It only cares about your actions. So what are you going to do? If you found this useful, hit the like button. If you disagree with any of these decisions, tell me why in the comments. I want to hear your perspective. And if you want more no-nonsense financial content that cuts through the motivational fluff and gives you actual strategy, subscribe to the channel. I'll see you in the next one.